So what if we were to have a system where you basically you do take market structure into account? Okay, so you have a system where you do look to sell, buy and sell the top and the bottoms of the bands, but you only look to do it, okay, when the market condition is agreeing with you. So for example, you may be looking to buy over here, but once the market has broken structure to the left, you don't want to be a buyer because the market is in a downtrend. So you would therefore miss all of this price action down here. So where other traders, new traders, will be losing because they don't understand price action, they don't understand market structure, you as a person who are putting things into context, actually, you wouldn't be trying to buy down here. You'd in fact be looking to sell. So the only opportunity you would have taken once the market broke structure is you'd be looking for a sell opportunity when the market came up to the top of the band. And you can see that that gives you much higher probability trades, even just taking a simple, I believe this is it's either a Bollinger Band or a Keltner channel. I forget which one I threw on there. It's arbitrary at the end of the day. All right. So as you can see here, trading with an indicator on your chart, it can help you. And where I think it really helps is ultimately it gives the trader confidence. So you understand market structure, or hopefully you guys do by now, or you're going to start to look into it. So once you understand market structure, then what you want to do is you want to come up with a trading system that suits you. Now, if that means throwing an indicator on there to help you confirm what you're seeing on the charts is actually what's happening. So let's say, for example, you see that this is in a downtrend here from a pure price perspective, and then obviously the channel's pointing down, then you're looking for sell opportunities, and you get to the top here. If your system would say to sell, and you've got that in conjunction with what a technical indicator saying to sell, okay, then ultimately you're going to have a much higher probability trade because you're trading in the direction of the trend. Does that make sense to everybody? So can I define market structure? Yes. I'll define that in just a few moments, Boyke. Okay? So what is the key? Well, I think this one thing here that I'm about to show you, if you can add this into your trading, whether you trade with indicators, without indicators, or whatever it is that you do, you will increase your chances of success a great deal. Okay? And what that is ultimately contextualizing price. Who's done that before? Who zooms out, who zooms out from their charts, okay, and sees what the price is doing, not just on one time frame, but maybe multiple time frames. So instead of being zoomed all the way in and only seeing 6 or 7 bars on your screen, actually you can see a few hundred bars. Because when you do that, and you do that on multiple time frames, suddenly you get a better idea of where the overall market is going. And once you've got a better idea of where it's going, then you're going to be in a better position to be able to make money from it. And I'll demonstrate this now. So this is a 1 hour chart. All right, this is a euro dollar on a 1 hour chart. And as you can see, it's trending down. Does anybody disagree with that? Who here is happy that ultimately this chart is making lower lows and lower highs? So it starts in the top left-hand corner and it finishes in the bottom right-hand corner. Are we all okay with that? Yes? Okay. So Boyke's the only one on this session today. All right, so 1 hour chart is pointing down. 4 hour chart. 4 hour chart is moving sideways, no? So if we go back to the 1 hour chart, this is in a downtrend. That same sort of period of time there on the 4 hour chart, actually, it's not really a downtrend, is it? What's going on here is the markets are just moving sideways. All right, so whereas if you were trading the 1 hour chart and you get to the bottom here, you'd be looking for a sell because the market's moving downwards, lower, lower high, lower low, lower low. You'd be looking for a sell opportunity here. We move on to the 4 hour chart. And actually, that's that sort of period here. That downtrend on the 1 hour chart, suddenly you can see that you're coming into a bit of resistance in a congestion zone. So the 1 hour chart's trending downwards. The 4 hour chart is actually consolidating, right? Let's take another step back. Exactly. How about the daily chart? Well, this here, that is that same consolidation period on the 4 hour chart. So actually, when you look at the daily chart, you can see that the market's just made a huge move up. It's pulled back about 50%. It's at market structure, so previous level of resistance here. If we drew a line in across there, you would see that that is now actually becoming support. So whereas on the 1 hour chart, we had a downtrend, on the 4 hour chart, we had consolidation. On the daily chart, we've got a huge up move. There's absolutely no merit in looking for a sell opportunity coming into these lows here. All right, because you're coming into market structure, you're coming into a previous level of resistance, which has now become support. The markets have a memory. They will react to those levels. When it gets down to that level, if you're lucky enough and you're selling, it will just smash through it and trigger a whole load of stops and take you to your profit target. More often than not, it won't get through the level. It will bounce from the level, and it will bounce in the direction of the overriding trend. It will bounce in the direction of the traders who made money last. And the last traders to make money on this chart, in reality, are these traders that were buying the market from here, from 118 all the way up to 132. The market then pulls back to around 126. What do you think these traders are thinking over here? All of the market participants that were buying the market from 118, they're thinking, I made some nice money there, traded that for over 1,000 pips. We've had a decent pullback, about 50%. What do you reckon we could do that again? So they buy the market again. The market has a memory. Why? Because the markets are made up of human beings. Yes, there are some automated systems out there, but the big money, the big moves, the big trends are going to be driven by human beings making the decisions. And they remembered making all of this money here. So the next time they get an opportunity to buy the market again at what they feel is fair value or even a bargain, they will do that. And more often than not, they will win that battle. Does everybody follow that so far? Excellent. So, understanding market structure, what if we were to put together another trading system? Again, arbitrary trading system. All I've done here is I've thrown the MACD on the bottom of the chart. All right, so we've got the MACD on the bottom here. Settings are absolutely standard. So what if we were to take an absolutely arbitrary system and combine it with price action? All right, so what we're doing here is I'm introducing you to something known as divergence. And what divergence is ultimately the chart telling you one thing, but the market's telling you something else. All right, so if we look at this chart here, the market breaks below this structure point here. It comes up to it, it treats it as resistance. Now we've got a level, all right, that we've identified. We've got a level that potentially we can trade from. So the next time the market comes up to this level, from a price action perspective, we're going to be looking to sell. Okay, because we want to sell resistance. We don't want to buy into a ceiling. We want to sell resistance because that's the highest probability trade. We know that the markets are selling off because that's what they've done here. So the next time the market comes up to this level, which we've already referenced to the left here once and twice, and actually if you go back, it's referenced a little more. Right, we already know we want to sell there. All right, we get our price action at the top there. And if we throw an indicator into the equation, so we've got the MACD here, we've got something known as divergence. So if you look here, the MACD makes a high, right? In the same place as this market makes a high here. The market then sells off a bit and comes back to that same high, to the same price point. However, the MACD, all right, the MACD actually makes a lower high. So what does that tell us? What that's ultimately telling us is that there's nowhere near as much power in this move here as there was in this previous one. So if there's not as much momentum with this move here, and that move sold off, then potentially this one could sell off again. And the market comes back up to that level, and again, we've got an even lower high. on the MACD. And what happens? The market sells off again. So there's a very, very sort of short, easy, what is the word for it? Example, sorry, of how an indicator can help back up your trading decision. So you can see that actually at this point here, we're trading price action. I've got support and resistance on my charts. I know where I'm looking to be taking where I'm looking to take my sell from. And actually it's wonderful because if we look at the bottom here, the MACD also confirms that.